UK housing market crash in 2021. Basically, there ain't gonna be one. In this video, I'm gonna share with you 8 reasons why there won't be a property price crash in 2021. I'm going to share with you 3 types of property that you really want to avoid like the plague, or should I say avoid like COVID-19 in 2021. And I'm going to share with you my 4-step plan to maximize the opportunity in 2021. So there's a lot to cover, so stay tuned. Now, my name's Ranjan Bhattacharya. I've been investing and developing properties for over 30 years. You may have seen me on Property Elevator, the hit Sky TV show for property investors, or you may have attended one of our property networking events in central London. Now, if you're new to this channel or you're not a subscriber, well, why ever not? Subscribe and hit the bell icon. We put out new content each and every week, and it's all dedicated to making you a more successful property investor. I've put out a number of videos on property prices and the property market. I'll put a recommended watching list of those videos in the description, so be sure to check that out. Now, there are lots of people on YouTube predicting a big property crash in 2021. Now, some of these people have been predicting crashes for years, but you know what? Even a stopped clock is absolutely correct twice a day. Now, I'm saying there won't be a crash in property prices in 2021, but I'm not saying there's going to be a massive boom either. Now, you hear a lot of people talk about the fact that the UK is a small island and we have a massive shortage of housing, and that is going to mean that property prices are going to go up, up, up. Well, that may be true over the long term, but it certainly isn't true over the short term. I mean, after all, the Isle of Wight is a small island. What's been happening there with property prices? In the long term, property prices will go up. So why are we so fixated with what's happening to property prices in the immediate future? Well, when you buy an investment property, the first few years of ownership is the most risky. You got to buy the thing. You got to make sure you cash flow it as quickly as possible. And you got to make sure that you exit out of the deal with as much of your money as possible. I've done a video on the Brewer method, which underpins what I've just talked about. So if as an investor, you're buying an investment property and it goes down, if you like, if you buy it at the wrong time and it goes down and prices do crash in the short term, that poses a massive problem for you. So let's get into it. 8 factors why property prices will not crash in 2021. Number 1 is the amount of money that the government has printed and put into the economy. It's close to £1 trillion, 3 times as much money that was pumped into the economy after the credit crunch in 2009. The value of your pound has gone down in real terms. And when they make money in more plentiful supply, what happens is the value or the price of real finite assets tends to go up. This is happening in spades. If you look at gold, for example, a 1-ounce gold coin a couple of years ago cost about £1,000. Today, it's upwards of £1,500 for that same 1-ounce gold coins. We're seeing right now massive upward movements in the UK stock market. Stock markets have experienced their largest gains over the course of the last 30 days than at any period over the last 30 years. Why is that? Well, companies, FTSE 100 companies, are finite. When the government prints so much money, what happens is that the value or the price of finite assets tends to rise to maintain the same value, if you like, as they were before that extra money was printed. This means that because of this extra money that's been printed, property prices will see a rise. But for the moment, unlike gold and the stock market, that rise will be subdued. In fact, I believe it will plateau. The reason for that is because we have the spectre of unemployment on the horizon. I mean, there's immediately going to be some short-term unemployment. We've got furlough schemes coming to an end in the first quarter of 2021. These will all subdue demand for property in the short term. But as soon as unemployment starts to bounce back to normal levels, as it will do, and it will do in a very short space of time, that's when we'll see a massive asset price bubble emerge, and particularly property prices will inflate. But do bear in mind, when I talk about inflate, that is not inflating the real value of the properties. That's just inflating them in terms of price, to keep the price the same as they were before the government pumped in £1 trillion worth of extra money into the economy. So as a hedge against that hidden inflation, investing in property is a surefire bet. Reason number 2 is long-term low interest rates. Interest rates, as we know, are at all-time record lows, and they're likely to stay so for the foreseeable future. By foreseeable future, I don't see any spikes in at least 7-8 years. Why is that? Because we are a more global integrated economy than ever before. The last time interest rates really spiked was in the very, very early 1990s. In 1991, we saw an overnight doubling of interest rates. They went up from 7-8% to 15%. Now, at that time, the world wasn't as connected as it is now, and major economies weren't as joined together as they are now. What happens now is that all the major economies tend to do things in sync. And at the moment, we have, for the foreseeable future, an ultra-low interest rate environment. Oh, and smash that like button, guys. It really helps us out on YouTube. And comment. Tell me what you think about what I'm saying below. Number 3 is the SDLT holiday. The stamp duty holiday in the UK comes to an end on the 31st of March 2021, but I believe that will be extended. The reason it will be extended is because the housing market hates cliff edges, and I think the worst time for a cliff edge is exactly in March, at a time when the economy will be looking to recover. So expect to see that holiday extended for the short term. Number 4 is the 5% deposit scheme for first-time buyers. And this is going to be absolutely massive in terms of underpinning the housing market. Previously, of course, new build developers of new properties could apply for the help to buy scheme, or should we say help to sell scheme, which allowed them to sell the properties to first-time buyers, and they only required a 5% deposit. Now, the amazing thing is the government is planning to extend this scheme to first-time buyers of second-hand property, second-user property, and that will be amazing. This is an ideological thing for the Tories, and I think it is going to go ahead. You see, the Tories know, of course, that homeowners tend to vote Tory, and what they're trying to do is encourage more home ownership to encourage vote bank for the future. So I believe that's going to happen. But that means a huge amount for the property market, because what it means is that people, first-time buyers, will be able to get on the housing ladder at record low interest rates with only a 5% deposit required, and not have to go for some of these expensive, overpriced new builds with high service charges and all of that. They can buy a 2-bedroom terrace property second-hand and benefit from that 5% deposit. Number 5, the whole world seems to be going green. Yes, there are going to be a whole raft of green incentives and grants, government grants, to help property owners with renovations, to basically bring up to standard the insulation and the energy performance of buildings. So as a property investor, if you're buying a dilapidated building which is in need of renovation, you will basically benefit from certain improvement grants. Number 6 is the city exodus. Now, the city exodus is temporary, guys. Now, we're hearing a lot about migration. It's as though, some people are talking about as though people are herds of wildebeests going across the plains, migrating away from the big cities, leaving these hollow places where they're going to be completely desolate. But mark my words, this is completely temporary. Once we've all had our vaccinations and we've got our papers that we have to walk around with to say we are COVID free and all of that, this is all going to bounce back because we are social creatures. People want people contact. Many of you may know I run the Baker Street Property Meet, the UK's largest property networking event in central London. Pre-COVID, we used to have 300 people come to our monthly networking meets. Not a week goes by when we don't get emails saying, when you're restarting Baker Street, when can we sort of meet up again? And that's because people strive or crave human contact. Now, it might be okay for some to flee the big city and go to some countryside bolt hole where the internet is on dial-up and you can walk your dog with a bit of fresh air, but there's no one to be seen for miles. But a lot of people like to be surrounded by other people, particularly young people want to be around people. And the best place for that is cities. And we see massive evidence of that. The minute there's any let up in any of the lockdown regulations that affect your part of the country, what do you see? Everyone goes down the pub and socializes and wants to be with other people. So the city exodus is going to be short-lived, and that's going to present short-term opportunities for the canny, savvy property entrepreneur. Now, number 7, unincorporated landlords. Now, there's a massive problem brewing for middle-class property investors who haven't bought properties through a limited company, who do a middle-class job, and they are in the 40-45% tax bracket, and perhaps they've got 1 or 2 properties which they have as buy-to-let investments on the side. These people are going to face massive problems. Firstly, with Section 24, the tax on their mortgage interest payments. They've lost 10% wear and tear allowance, and Rishi Sunak has proposed extra capital gains tax for people that own second properties in their own name. Of course, if you own properties within a company or you're a portfolio landlord with properties held within a company, you're not going to be faced by this kind of issue. So there are going to be some middle-class landlords in professional jobs who don't do property as a business. They just do a couple on the side. It is going to prove uneconomic for these guys to hold on to their properties in many areas. And these guys will look to sell. But I believe these properties, this stock, is going to be mopped up by first-time buyers taking advantage of the 5% deposit and ability to buy at very, very low interest rates. Number 8 is the job situation. There's no bones about it. The job situation in the short term ain't good. It ain't rosy, and there's going to be a bit of doom and gloom. But the axe is going to fall disproportionately on the low-skilled job market. And that's one of the reasons I'm going to urge you to avoid low-value areas. These will be risky over the next couple of years. Now, what I've talked about is very general. The housing market is not the same in every area, and every type of property is not affected by the same trends that I've talked about. Now, what I'm going to go on to now are 3 types of property which really you should avoid in 2021, because those are going to give you trouble. But before I do that, make sure you've liked this video. YouTube shares it with more people just like you. So 3 types of property which are too risky for 2021. Well, I'm saying the market will plateau. We're not going to see too much happening in terms of rise or fall in 2021. After that time, we'll start to see some boom, boom, boom. When the market's plateauing, one thing you want to stay away from is new builds. And I'm talking in particular about new build flats. New build flats often command a premium to a second-hand property, and now is not the time to be paying over market value for a given property, particularly when these also come with very high service charges. So new build properties, stay clear. These will fall in the short term. And low value areas. Now, low value, desolate areas will be challenging. There's a reason why certain properties in certain locations are cheap. Often it's because of the job situation. The job situation was dire before COVID, and guess what it's going to be after COVID? Even more dire. And often these areas are in areas where, according to the national census figures, the population is actually decreasing year on year. Now, there are plenty of areas in the northeast and the northwest of England where property prices have not even moved since 2007. Now, stay tuned to the next section and I'll share with you exactly how to avoid investing in low value areas. And the third area of concern I have is HMOs. HMO demand in many areas is reaching saturation point. A lot of HMOs are aimed at tenant groups who have been most savagely affected by the unemployment situation that's unfolding. And also, particularly in cheap areas, there's been a massive rush because the properties are cheap, there's been a massive rush by new investors to go out and buy these properties and make sort of 5-bedroom HMOs and the like. And they've found that the tenants are simply not there. Brexit has also had a role to play. People came from Europe to live temporarily in HMOs while they worked a few years before they went back home. That market has disappeared. So I'm seeing and I'm hearing from a lot of people who with HMOs struggling to maintain anywhere near full occupancy and are looking to convert them back into single family lets. So HMOs in low value areas is something to avoid. So let's draw some of this together as I share with you my 4-point action plan for profiting from these opportunities in 2021. So number 1, don't wait for the crash to happen, because it ain't gonna happen. Except for certain types of properties, as I've discussed, the new builds, the low value areas and the HMOs. Expect more of a plateau in 2021. Keep an eye out on the unemployment figures. As soon as the job market returns to pre-COVID type of normality, we will see boom, boom, boom. So number 2, don't invest in low value areas. What do I mean by low value areas? The average house price in the UK is now £250,000. So what I'm saying, if you're investing in areas where you can pick up a house for 40 grand. That's the average price. That's what I mean by low value. That is desolate. As a rough rule of thumb, I would be looking to invest in areas where the average house price in that locality is in excess of £200,000. You can find that information out from Zoopla, Rightmove. They have past sale price data and averages per region, and also Land Registry. Number 3, focus on adding immediate value. Don't buy stuff you can't add immediate value to. Now, I've talked about the BRRRR strategy and we've done a video on that. Now, when you implement the BRRRR strategy in a plateauing market that isn't going anywhere, the way you pull your money out at the end is pretty much by making sure you can add significant value to what you're buying. In 2021, one of the best ways of adding value, real value, to properties that you purchase is going to be commercial to residential conversions. Now, this is a subject that I run some specialist training in, and I also have a free 90-minute webinar on the subject, which you can join me on. And the link is on the screen and in the description below, property-workshop.com. Number 4, focus on cash flow. Anything you buy needs to cash flow positively on or as close to day one of purchase as possible. Remember, you're borrowing at record low rates. Your rental income needs to cover those costs and produce a surplus. That will tide you over until when the market starts to grow in terms of asset value. And of course, I mentioned earlier in the video that we've got a lot of the middle class landlords who are unincorporated. They're selling up because of Section 24, capital gains tax and all of that. This is going to mean that there will be more demand for rented housing. So that about sums it up. Let me know what you think in the comments below. Just to sort of give you the summary, if you like, £1 trillion has been printed, and that money is going to go into the value or the price of finite assets. We've already seen that in gold. We've already seen that in stocks and shares. It's going to happen in property. It's just going to be a bit subdued for the next year or so until the unemployment situation is sorted out. And then property will go the same way as gold and stocks. So 2021 for the savvy entrepreneur is the ideal time to get started in property or to build up your property asset base. To help you do that, we put out new videos each and every week. Make sure you've subscribed if you haven't already done so. Smash that bell-like icon and we'll see each other in the next video.